say welcome back on stage to Sony Kapoor, Managing Director of the international think tank Redefine, talking on the topic Winter is Coming, the future of institutional investing and asset management. Welcome, Sony.
Thank you. I notice I've scared about half of the room away. I assure you by the end of this, I would have depressed the rest of you so much, you will all leave. So how should we start? Okay, let's start with this way. I think, and you may disagree and stop me if you do, that we have ended a golden era in the world of asset management and institutional investors. And there are 10 reasons for that. Let's go through each of them one by one. The first one I spoke about briefly this morning, which was politics, that we were fortunate to have had our professional lives and careers begin at a time where politics was favorable, where there was a reasonable consensus on what was good policy, and it was very favorable to the financial sector, to asset valuations, and to asset management, at least up until the crisis. And where we left off in the crisis, with the bad politics starting to emerge, other factors such as quantitative easing helped us, right? So the politics is the first one. The second is interest rates. If you remember the reign of Paul Volcker and his shock interest rate policy back in the 1980s, the good old days when US Treasuries yielded 8%. And what the world has seen effectively since then is a more or less secular decline in interest rates. And what happens when interest rates decline? Asset prices rise, right? So that was the second big factor. The third was China. China's arrival into and slow integration into the global economy, particularly since it joined the WTO in 2001, has resulted in the single biggest redistribution of gains away from labor towards capital, right? Which really helped with profitability and valuations. That was the third big factor. The fourth was the rise of the big tech, the FANGs and the BAT, where if you go back 20, 30 years back, the percentage composition of any of the major stock market indices, tech companies were there, but there were different tech companies and they were not so big. And today, the FANGs are roughly about 20% or something of the S&P 500. And you have, of course, benefited from it if you're invested in the index or if you're invested in any of them. So that's been another big factor. The fifth factor has been the more or less secular decline in corporate tax rates. The received wisdom has been that lower corporate tax rates are better. There's been tax competition amongst countries, for example, within member states of the EU and from tax havens. And there's been a general decline in corporate tax rates. And what does that do? It leaves free cash flow for investors to take, which also helps with valuation, right? So we've already reached 5 factors. The next one was demographics. So if you look at sort of the golden post-World War II era for the OECD, there's been 2 major factors of growth. We've had a nice, good run. Sweden has built a fantastic state. Even your poor country cousins, Norway, mostly because they got lucky with oil, have built a fantastic state. But effectively, all of the OECD has had a fantastic run since the end of World War II. And demographics have been part of it. So if you look at growth in the OECD, there's been driven by 2 major factors, roughly half of which was favorable demographics. Of course, if the actual number of workers in an economy rises, the GDP will rise, right? And that's been a big factor up until recently when that has started reversing, but we come back to that. The second one has been productivity. So demographics and productivity contributed roughly half each to growth in the OECD over the past few decades. And for the most part, they were favorable to us. We spoke about the crisis before, and since the crisis, when politics started turning and the fires were burning, quantitative easing has really helped. As the Schroeder's gentleman this morning pointed out, $15 trillion is roughly 1/3 of the total market value of MSCI World. There's been a lot of money pumped in to buy a limited pool of assets, which hasn't really increased much, right? I mean, there hasn't been a spate of IPOs. There hasn't been huge new issuance of equity. Instead, in fact, there's been a lot of buybacks. So effectively, you have been paying more and more to buy into existing productive capacity, listed OECD country shares mostly. And that, of course, results in higher asset valuation, right? So far, we have discussed a number of factors which have all roughly pushed in the same direction. What is the next big factor? If you remember, there was a huge discussion of the internet bubble about whether or not the technological changes and internet was contributing to productivity gains. In some countries, it seemed to be, particularly in the US, in others it was not. The evidence has moved on, and the answer is it did actually contribute and give a productivity boost to many of the OECD economies. Now, of course, as I said this morning, and we'll come back to that, we are starting to see some of the negative impacts of that. But thus far, it has contributed significantly. The next big factor which helped us in this golden era was environmental degradation. Like it or not, but if you look at the actual economics of where growth has come from, depending on who you believe, between 1/4 to as much as 1/3 of growth in the OECD has come at the cost of environmental destruction, for which we haven't yet had to pay the bill, right? So that is an important thing to keep in mind, and eventually this bill will have to be paid, but for now we've had a good time. We've enjoyed the party. The next one is what I think of as stewardship. Between you in this room, you own and run tens of billions of dollars of assets. Some of you asset managers, others are asset owners. To our best estimate, the total amount of money that asset managers and asset owners put into stewardship, into corporate engagement, into proxy voting, into nomination committees, the whole responsibility that you have as owners is less than 0.3% of your wage bill, right? And if you look at the pecking order in a fund, it's often not the corporate governance people who are the best paid. BlackRock made a huge noise about doubling its team, and it was going to take corporate stewardship seriously. So it's going to increase its team from 40 to 80 people out of 16,000 employees. And these are not going to be the ones taking $1 million salary packages home every year, right? We have neglected our corporate stewardship role, and by not paying enough as a system, we have again benefited. A price will have to be paid. Last but not the least, on global governance, we had a time where many of the institutions, be it the BIS, be it the OECD, be it the IMF and others, and the network of central banks that we spoke about earlier, have over most of the past few decades moved in the right direction. The Washington consensus was great for asset prices for a number of years. So these were the 10 or 11 factors that returned close to high single digits to low double-digit returns for many of the world's asset owners over the past few decades, even if you had the 60-40 stock bond portfolio mix. It's been a fantastic, fantastic run, but sadly, this has ended. Let me quote a few more numbers that may be interesting. So 2/3, actually more than 2/3 of all of these fantastic returns you have seen have come not from dividends or cash flows, but have come in the form of capital gains, right? And it's very clear what these capital gains have been driven by. Many of the factors I spoke about, be it the corporate tax decline, interest rate decline, etc., they have really, and quantitative easing, they have really pushed up asset valuations. So let's look at each of these factors in turn. and think about where they might be going. One other interesting statistic to keep in mind is back in 1985, roughly about 30 years back, if you look at the percentage of Standard Poor 500 that came from tangible versus intangible assets, right? So that was the time what we like to think of as the old-fashioned productive economy, manufacturing jobs, things you can sit on, stuff you can eat, stuff you can drive, right? And the stock index reflected that. So back in 1985, I think roughly 15 or 17% of the S&P 500 index came from intangibles. All the rest was effectively tangible. What is the percentage now? As of today, 87% of the valuation, the market valuation of the S&P 500 index comes from intangibles. 87%, right? At least with the things you can drive and sit on, if things go bad, you can sell them in an asset fire sale. If you lose your reputation, if you lose your brand, if you suffer from catastrophic loss, if you get sued out of existence, what are the huge intangible assets and goodwill and brands that you will be able to hold on to as creditors or investors? I just thought I'd put that out in the air, right? So let's look at each of these in turn again. First of all, politics. We spoke about that this morning already. I don't think we need to repeat it, but just one-line summary would be, time was that it was the economy stupid. Now the time is it's the politics stupid, and it's not looking very good. Number two, interest rates. Yes, we are going to have lower for longer interest rates. The Riksbank keeps postponing, as it did recently again, the time it's eventually going to hike the interest rate, the time we will eventually meet the 2% inflation target, which may or may not happen. But the point to remember is never again, even if we get the e-krona and further negative interest rate, we will almost surely never again, at least within our living memory, see a decline in interest rates by 5%, right? And it was that change in interest rate, that decline, that drove the asset price valuation. So to the extent that the decline in interest rates drove up asset prices, that we can't count on. If anything, if the other central banks follow the Fed and we slowly start normalizing interest rates, this will start hurting asset valuations, if anything. So this factor may go in reverse, just as politics has turned against us, right? China. We are never again going to see the arrival of another China into the global economy, in the global trading regime. I can assure you that India is no China, and it will never be, for a number of reasons, the most important of which is the Indian economy's structure is very different. It's primarily driven by domestic demand. And second, India is arriving into the global economy at a time that it's too late already. India will have to be the first country that actually develops with a new model that hasn't been tested yet. The one model that has been followed by every single decently sized country to have industrialized in the past few decades has been the export-led growth manufacturing model. You slowly climb up the value chain. By the time India is arriving on the scene, it's already a bit too late. Technology has already moved on to the point where even textile workers command wages that are higher than what a machine can produce the same textiles in. I was in India working for a few months with the Indian government back in 2013. And one of the things we noticed that was very surprising was, even when it did not seem to make financial sense, a number of entrepreneurs were choosing more expensive, technologically intensive investments rather than choosing investments where they could hire loads of cheap workers. You might also be surprised to know that the Indian IT industry, the flagship of great Indian economic success, employs only 2 or 3 million Indians. And there's 10 million Indians that come into the workforce every single year, right? So India is not China. And that's important to remember, which means we will never again see that level of redistribution away from labor towards capital. Technology. We are going to see technology, but as we discussed this morning, be it on the slow erosion of jobs, the slowdown in job creation, or be it through other negative impacts, such as you wasting time at work on Facebook, reducing your productivity, or worse, the disinformation and all the other negative impacts that come that we haven't yet seen the full impacts of with technology. And I'm not even talking about killer robots, right? So what is new is that technology, we are starting to see both the Dr. Jekyll and the Mr. Hyde side of technology. So it's not going to be a singularly positive driver for valuations as it was. Demographics, as you heard today, has started to turn already in Japan, in Germany, and in a number of other OECD countries and countries in Central Eastern Europe. The absolute number of workers has started to decline, which will become a great drag on growth. It won't become a drag on GDP growth per capita, but it will become a drag on GDP. And of course, for debt servicing, you need GDP. For the size of the economy, you need GDP. You can have smaller levels of profitability if GDP per capita is growing for small firms, but you can't have a huge expanding business. So demographics is going to become a drag. Quantitative easing. The Bank of Japan, as was said earlier, may never actually exit quantitative easing, and that's fine. But the other central banks perhaps someday will ease. At the very least, they are not buying in the same way they were before, right? So even if the 15 trillion gets rolled off, even if they never sell back any of the things they have bought, they are probably, short of another huge financial crisis, in which case we'll have other things to worry about, they will probably not be injecting $15 trillion of cash into the global economy in the next 10 years. So that is not going to be supporting your valuation again, right? So we are facing an increasing number of factors which were, as the gentleman from Schroeder said, which were providing us tailwinds, which are stopping or have died off, and some of them are actually becoming or have become headwinds already. The productivity gains we saw, we have moved a lot. There's been a lot of technological gains, but the fact of the matter is productivity in the OECD has slowed down, and it's normal, right? We have an aging population, we have a debt overhang, and if you are at the technological frontier, it takes time to innovate, right? We can't expect a new theory of relativity to be put forward every decade or so. A lot of research and development is serendipitous, and the further we are on the curve, the slower it might be. So productivity gains and productivity slowdown, at least, is here to stay, as far as we can tell. What you have on the environmental side, and we will come to the environment at the end, is huge liabilities, huge potential liabilities. Sadly, not so sadly for people in this room, but Sweden, unless the Gulf Stream reverses, is going to be one of the economies that's going to be, I guess, less affected. India is going to be one of the economies that is hugely affected if climate change happens as is likely as of today. Already one is starting to see those huge impacts. Extreme weather events in the world have increased 5 times in the past 30 years, 5 times already. Global temperature is already up 1.1. In the oceans, as many as 15 tipping points of irreversible change might be about to be triggered. We're losing biodiversity like never before. If you look at global food supply today, if all of global food stocks today are evenly distributed, we have enough for 3 months, pushing it maybe 4 months. If we start eating animal feed, we might be able to push it to 7 or 8 months. But if there's a volcano or an asteroid or a huge variation in weather which significantly destroys a large percentage of crops, we actually don't really have global food security for all of us at a global level. we are literally looking into the face of disaster from a sustainability side. There's something called the Earth Day, so that is the day of the year that you're using the whole share of sustainable planetary resources, right? As recently as, and again, I'm talking about the same time period of 3 decades, as recently as 1987, it used to be December the 19th, right? So the time we had used what was a sustainable amount of resources of the planet was December 19th. So we were almost sustainable. Guess what it was last year? August the 1st. In a short span of 3 decades, we have moved to consuming 1.7 times the sustainable level of Earth's resources. This simply cannot continue. The arithmetic doesn't add up, the science doesn't add up, and something has to give, and a price has to be paid, and we will be paying that price in one form or the other. So, that is where we are. Let's also look at stewardship. And I know many of you are involved in various stewardship initiatives. We have a white paper coming up with some of you. You will eventually have to start picking your responsibility, taking your responsibility as asset owners and asset managers seriously, which means you will need to put some money into it and some effort, which means you will need to engage with companies that are still doing coal, companies drilling oil wells that are fundamentally incompatible with Paris targets. You will start needing to not just avoid doing harm, but most importantly, actively start seeking where these resources, what parts of the economy, which country, what sectors actually need your money. Danish wind turbine investment is not one for Swedish pension funds. It may look nice and interesting, but I think as the gentleman from Switzerland said, there are 50 institutional investors ready to put money into German onshore wind power. They don't need your money, and you won't really get returns. Indian solar power does. Kenyan hydropower does. Whether you like it or not, sitting on the sidelines saying, okay, I'm doing no harm, I'm going to divest, okay, I'm going to engage, I'm going to gently nudge Shell to talk about what their plans for Paris are, that's just not good enough. There isn't time for that. You have to actively seek things, do things you haven't done before, and the fact that AP regulation is changing means you have more dry powder, you have more options to actually seek illiquid assets, to actually seek solar power plants that actually need your money, which will also help you diversify risk. So let's go to that point, right? So we've now discussed the overall fact that the kinds of returns we saw in OECD investments are not going to happen again. If anything, they're going to be significantly lower. Our best estimate for work we did together with the London School of Economics is that the 60-40 standard listed stock bond mix in the OECD is probably going to get you 3% or 4%. So we are significantly lower than where the gentleman from Schroders was. And that's us being slightly optimistic. But let's set that aside. The fact is things are changing. So where are we right now? So let's look at some numbers. Let's pick a number out of thin air and call it 80. So there's roughly $80 trillion of long-term assets under management in OECD countries. Roughly 80% of it is invested within OECD countries. And within each of the continents, for example, in Asia, if you look at Japan and the Japanese economy and Korea, there's an 80% home bias. In Europe, the home bias is slightly lower. It's 64%. In the US and North America, it's 70%. But again, 80 is an interesting number to look at. And some of you call yourselves active investors. Others actually say we are passive index trackers. But whoever you say you are, this 80 trillion taken together, roughly 80% of it actually tracks the index. Even if you say you are active, you're marginally overweight or marginally underweight a sector or so. Right? But the fundamental fatal attractor is the index. So this is what we're looking at. 80 trillion, 80% OECD countries, 60 to 80% home bias, roughly 80% simply tracking the index. And if fossil fuel companies are part of the index, so be it. Your capital will go there, whether you like it or not. If there is no large listed solar firm that makes it into the FTSE 100 or S&P 500, well, that's not your problem. You're investing the index and they're not part of the index. If there's as yet promising technology in new batteries or in the circular economy or in water management or in extracting fresh water from the sea, because it's not in the index, you don't see it. You have so few people working for you, particularly if you're one of the asset owners. Not only do you not have the time to look at anything that's less than $100 million, but you don't even have time to talk to people who can aggregate that 5 million, 10 million investment from here and there in Kenya or in India, which might actually do something useful for the economy and actually make it sustainable, right? And this is the truth that we all know. I haven't said anything controversial thus far. So, this is where we are. To add to the drama, the fact that so much of your portfolio is in the OECD, the fact that so much of it is invested in these economies. What is common between the OECD economies? Well, we trade a lot with each other, right? Even with Trump's trade war, there's a lot of trade going on between Germany and France and Sweden and the United States and all of that, right? What's the next common thing? If you go back to 2009, your banks borrowing short-term dollars, lending long-term Swedish krona for the housing market, the same in Norway. We have a huge, very strong financial interlinkage with the rest of the OECD, right? So here's a group of countries which have very strong financial and economic interlinkages, which are facing similar structural factors of demographic decline and stagnating productivity. And I know in Sweden, it's a slightly surreal discussion of should you spend more and almost paying off your entire debt, public debt. But if you followed the discussion in Italy and elsewhere, it's quite the opposite problem. The US deficit last year was going to be $800 billion when at the time of the financial crisis it was about $100 billion or 150. So it's increased roughly 5 times. Right? And that's a fiscal deficit. OECD country public debt has risen by 30%. Global aggregate debt has risen by between 70 to $100 trillion in the past 10 years. In each of the past 3 recessions, the US Fed cut interest rates by 5% each. That's not going to happen this time. The politics we already spoke about, the center has fragmented, the space. Imagine if you were to design a bailout package. Mr. Stefan Löfven went and was sitting at the table with President Trump, trying to save the global economy or the Swedish banking system. I'm not sure how well it'll go. How strong is the WTO today? How powerful is the IMF? How seriously does one take a World Bank under new management, right? There has been a significant deterioration in domestic and international policy space. We have less fiscal and monetary policy space. It's not all doom and gloom, but let's have some perspective. And going back to what we said briefly this morning, what matters is relative risk and relative return, right? And what has happened is relative return has fallen significantly in the OECD because the dynamism is Asia, right? The new technology is in Asia. India is not wasting the hundreds of billions of dollars that was wasted laying copper cables for landlines. When I was growing up in India, we had 2 landlines per 1,000 people. And from that, it went to having more or less 1 mobile phone per head. We never wasted all that copper. There can be technological leapfrogging. There can be catch-up. There is much faster growth. That is not to say there are not risks. As I pointed out, there is a big question mark about India and about the effect of technology on developmental catch-up. There is, of course, a question mark about the politics. You know, Bolsonaro is Latin America's Trump. But if you were being honest and you saw where the dynamism was, where the potential was, where the demographics looked better, where there was actually support for globalization, and believe it or not, there is conventional monetary and fiscal policy, right? So what are the countries in the world which can cut interest rates if there is a new recession? It's India, and it's China, and it's Indonesia. It's not Sweden or Denmark or Germany, right? Where are the countries that have actually slowly paid down their their debt. It's Sweden, yes, but you're different. Let's not talk about you. It's Norway, they have the oil, but for the most part, it's not Italy, right? So many of the emerging economies are actually following policies that we put in place, right? I mean, what we used to call the Washington Consensus. So support for globalization, optimism, catch-up, etc., it's all out there, as is the need for investment, right? Domestic savings in India are high, but haven't reached the kind of levels that China or Southeast Asia saw. And those savings are mostly in the form of liquid savings. In fact, they are not the appropriate quality and quantity of savings to invest in the energy transformation. And you will be affected, not just the Indians, if they set up the next coal-fired plant instead of a solar project, right? So it affects all of us. And we have a responsibility towards our savers, our citizens, because we need to find returns and we need to diversify risk. The risk-return trade-off, whether you look at the risk side of the equation or the return side, is becoming significantly more favorable, particularly if you look at your present portfolios. When somebody asks me, when we work with investors, is this a good investment? I say, I cannot answer that. What does the rest of your portfolio look like? If you were having 40% of your portfolio in emerging markets, and you ask me to look at a marginal solar project, I would say, no, don't waste your time, right? But if your portfolio looks as it does today, I think it makes sense, even if the returns are in high single digits, even if they are not the 15% that you want from emerging markets. It's a sensible investment to look at. So whether we like it or not, the best opportunities, no matter which way you look at it, if you think of the SDGs as a secular investment theme, whether you want to fight climate change, whether you care about clean water, whether you look at political risk, whether you look at fragility and the ability to be able to respond with counter-cyclical policies, the fact of the matter is the best investment opportunities are no longer in our home domain, but out there in countries we know less about, despite Hans Rosling's effort year after year after year to educate us. But these countries are not what they used to be when we were growing up. And I think somebody mentioned on stage earlier that we are shaped by the experiences we had in our 20s. And in the lives of many of us in the 20s, political risk was something out there in developing countries. It was developing countries that had crazy prime ministers and presidents. It was developing countries that had unstable political situations. It was developing countries that had debt crisis, right? It wasn't us. And now that has changed, but our perception hasn't. And sadly, we have too many of those biases remaining. So, where does that leave us? And what can we be doing? Let me end with a couple of more honest remarks. So we looked at many of the large Nordic investors as well as global investors, particularly everybody, and there's been a lot of talk about ESG today, right? Mostly optimistic, about ESG integration. So what we did was we got confidential access to the investments of many of these large institutional investors, including some of you in this room. And the question we asked was for everybody who claims to have signed up to the principles for responsible investment or who claims to be investing along the SDGs or who claims they have full ESG integration, the question we asked was, how much capital are you deploying differently as a result of having signed up to this commitment? And the answer we got was at the system level, it was 0.3%, right? I mean, I've thrown out some big numbers and some big challenges, and Greta is still outside the parliament. And I'm afraid 0.3%, a few years after you have signed up to a commitment, deploying 0.3 of your percent capital differently is not going to cut it. So either you are contesting the claim that the way capital was being invested before was not good enough and was not compatible with sustainability, right? I'm assuming nobody in Sweden is at that stage anymore. But then you can't claim to be the sustainability champion of the world, have Per Bolund champion Sweden's sustainable financial center and talk about all the great things AP funds are doing, have everybody pat you on the back and willingly, smilingly accept that we are doing a good job, when the truth is, If the rest of the world looked up to Sweden and copied us, we are all doomed. We may be the very one-eyed in the land of the very blind, but that's just not good enough, right? I mean, we're lucky. We have a fantastic economy. We have a low level of inequality. We've got a great educated workforce. After the coalition negotiations, we still have hopefully a reasonably stable government. And we have a lot of savings. And we are, unlike many pension funds elsewhere in the world, we don't have a deficit. We can be and should be taking a more stronger leadership role. We're lucky. If we can't make this happen, on what basis are we going to talk down to the Indians and the Chinese and make them change the way they operate? 0.3% is not good enough. And this is even before one looks at how any investment can be said to be ESG compliant, right? There's 20 information providers out there. The information doesn't match up. Whether you say, I'm emphasizing environmental or social or governance aspect, you can have disagreements. You don't spend much money engaging with the companies that you're supposedly owning. There's a huge dereliction of duty going on. I'm not saying you're bad. I think you're wonderful, which is one of the reasons I work here, which is one of the reasons I live in the Nordics now, which is one of the reasons I'm here every month. But you are at best the very one-eyed in the land of the very blind. And misquoting Spider-Man, with great power comes great responsibility. And it's time for you in Sweden and the asset owner community and the asset management community to shoulder yours for the sake of your stakeholders, pension holders, and for the sake of the world. This is one of those rare occasions where the drivers of risk, return, diversification, and sustainability all point in the same direction roughly. Let's not waste this opportunity, and thank you for having me.
Wow.
Sorry.
That was... Well, thank you so much, Sony. I'm going to ask you to stick around on stage in case there are any questions to Sony Kapoor from the audience. We haven't had that many questions today, but this is your last chance, so take it. Anyone or a comment? Okay. Well, then I just have to ask you though. We've been hearing a lot today about all these tools coming up, and all like how we're improving measurements and seeing that we actually do. Maybe we don't increase the returns, but actually we can stay on the same level of returns, the same level of risk, and reduce our impact. I mean, good things are happening though, aren't they?
0.3%. At a time, we're already 1.1 degrees into what is supposed to be a 1.5 degree warming target. It's just not enough. And frankly, again, we are amongst friends, so I can say this. If we look at ourselves in the mirror, it's a joke. And we need to do our duty. We're not doing it, we're failing. And I'm as responsible as the rest of you are. I used to be an investment banker and a derivative trader. And one of the things that I realized, so this is just digressing a little bit, but I'm a recent father. And it's my first. And before this, if anyone had said to me, oh, you will understand things when you're a parent, it used to irritate me because it sounded very condescending. And anytime a politician or anytime a business leader invoked their children, we have to do something about climate change because of our children. I was like, I don't have a stake in the future. I was not particularly planning to have kids. And I've been working on climate change for 15 years because it's the right thing to do. So I didn't really understand it. But now, if I'm completely honest in this room with you, I have my 2-year-old who's actually Swedish running around. And every time I see him, I see 2100 in front of me, right? He's 2100 running around in front of me. And all of us in this room, we don't have any excuse for not being well informed, right? We already know how bad 2020 is going to be. We already know how bad 2030 is going to be. We know how bad 2050 is going to be. How can you look your child in the eye, knowing how bad things are, without doing every single thing in your power to make sure we're not screwing up their future entirely? And which is why I applaud Greta. She's controversial in my country, in the UK now, but they're idiots, and I think it's wonderful. She's Sweden's best export, perhaps after Volvo.
All right. Anyway, thank you so much for coming.
I'm sorry to end on this message, but thank you for having me.
All right. Round of applause.